Hey everyone, and thanks for jumping back into the macroverse. Today, we're going to talk about the most recent CPI report, and of course, we will discuss implications for things like Bitcoin. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. The Fed's objective is to get inflation on a path to 2%. And one of the things we were tracking earlier this year was that the summer of 2024 compared to the summer of 1972, and probably Powell looking back at that first wave of inflation and getting concerned that if they cut prematurely, it could lead to a second wave of inflation. If you look closely, you'll see that the headline inflation bottomed out just below 3% in 1972. But this time, you can see that it went just below 3% in the summer of 2024, and then it dropped to 2.59% in August, and then the Fed decided to cut in September. So I think the Fed got the data point they needed to justify the rate cut, right? Rather than see it tick back up, they saw it go down, which, by the way, is what we said was the more likely outcome. Now, why was inflation dropping the more likely outcome in the short term when in 1972 it went right back up? Well, the reason I think it was the more likely outcome this time is because the unemployment rate in 1972 was actually going down, right? It was dropping. So it topped in 1971, and then it was dropping into 1972, 1973, which made more sense that the inflation would start to go back up. But in this case, we're seeing the reverse, right? The unemployment rate has actually been going up. So it made more sense for inflation to go down as the labor market loosens up. Remember, wage inflation is one of the main components, and if the labor market is loosening up, that puts less pressure on wages to go up, and therefore inflation tends to not be quite as high. So inflation this month, headline inflation came in at 2.4%. Obviously, there were some headlines today about inflation missing expectations. I guess the quote unquote experts were calling for 2.5%. I wouldn't really worry too much about what the quote unquote experts are calling for. I would just look at the general trend, right? The general trend is still down. Okay. And obviously, the goal is to land the plane at 2% and not to go below 2%. Now, I don't really think there's a single person watching this video that would have any problem with the, inflation becoming actually deflation, right? Do any of us necessarily care if, the prices the price of goods and services starts dropping? I think a lot of us would welcome it. Okay? The only real issue with that kind of stuff is it can be a drag on risk assets. So, you don't really want to see it as an investor because it could be a drag on risk assets. Now, again, outside of your investing careers, right? If you're just talking about in the world and buying goods and services, again, I think most of us would be extremely happy if our grocery bills could go back to where they were in 2019, but I don't think a lot of us would be equally as happy if asset prices went back to where they were in 2019. So, it's one of those things where in order to actually get lower prices, in at the grocery store, it probably wouldn't be super great for the economy because again, if inflation is dropping, if it's becoming deflationary, of course that's going to hit the bottom line. So what Powell wants to see is this drop to 2% and stay there, right? And stay there. Well, we'll see, right? We will see what happens. But so far it's been moving in that direction. I do want to break it up by category. Okay, so here's headline inflation. So let's see what components actually are at least partially responsible for the continued drop. Is it food and beverage? No, actually, food and beverage inflation actually went up from 2.06% to 2.23%. So it's not food and beverage. I mean, food and beverage inflation has actually been right around 2% since February. Um, so nothing wrong there, and it oscillating around a little above 2%, I think is fine. Housing, what we talked about, right? It's the most lagging of the inflation metrics. Um, and it makes up like 2/3 of it essentially right now. It dropped from 4.34%, which it had been around 4.3 to 4.4% for several months. It then dropped to 4.08%. So if you look at a monthly change, the last time that housing inflation had a monthly change this large was all the way back in December of 2023. So it's been a while, right? It's been a while since housing inflation dropped that much. When it drops that much, it has a really large effect on the overall headline inflation. And that's one of the main reasons why headline inflation continued to drop, even though you might see some categories like food and beverage where it actually went up. If you look at apparel, it also went up, but it went from 0.294% to 1.8. So it's still, around 2%, I think is fine. I'm not really that concerned about that increase to 1.8%. Now, transportation has remained deflationary, right? It dropped from negative 0.72 to negative 1.27. But again, transportation often goes deflationary, and it can go deflationary even in times without a recession. Sometimes you'll get, maybe a recession scare like in 2015, 2016, but you don't always have this is over here, this is 1987, right? That was when the stock market had a pretty big drop, but there was no actual recession. So transportation is deflationary, but it also went deflationary at some point last year as well, and here we are, right? It just hasn't really changed. Medical care went back up, right? So from 2.98 to 3.25. So it's kind of interesting because a lot of the categories have actually, at least some of them have actually gone up, right? Medical care went up, food and beverage went up. But again, housing is a big component. Now, recreation dropped a lot. Okay. And I was wondering, when this was going to get another big drop, because it's kind of what it does, right? It'll plateau at a level, then it'll get a big drop. And so it kind of went up to this level and then another big drop. So it dropped from 1.55% to 0.699%. So this is a really important thing to see. This part of inflation has not often gone deflationary, right? You can see a little bit here and there, but for the most part, it hasn't, with the exception of, say, the financial crisis, where it very much went deflationary. So this is probably one that it might be worthwhile to keep an eye on because, 0.699%, again, no one over here is going to complain if the prices don't go up as quickly. But in terms of keeping inflation at 2%, with recreation dropping to 0.699%, that could represent a drag in the future, especially if housing continues to drop. Education and communication dropped from 1% to 0.889%, not a huge drop there. And then other goods and services continues its drop from 3.94 to 3.55. So one of the things I've mentioned, though, is that they're not all the same in terms of their contribution, right? So then to get the contribution, that they all have different weights, right? We know that they're all weighted differently. And so we can go through this and see that, food and beverage actually makes up a significant component of headline inflation, right? If you look at headline inflation, it's at 2.41, and food and beverage made up 0.32 of the 2.41. So more than 10%. So food and beverage clearly does have an effect. So had food and beverage continued to drop, then headline inflation would probably be at, 2.2 or 2.3%. But I think, that going back up certainly helped headline inflation to stay a bit more elevated. You can see the contribution from food and beverage went from 0.295 to 0.32. So it actually went up. If you look at housing dropped from 1.93 of the 2.59 to 1.81 of the 2.41. So it still makes up approximately 66% of the overall inflation, but that's one of the main reasons why it continues to come down. And if you guys go back to where we were a year ago with inflation, we said that housing would be one of the last ones to really drop, and that's why there would be a drag on headline inflation. So while a lot of people might be calling for an immediate second wave of inflation, that just hasn't really been the most likely outcome. It doesn't mean that you can't get a second wave of inflation eventually, but I'm guessing that if we get one, it's going to be, pretty far out, right? I mean, probably later next year at the absolute earliest rather than this year. And I think a lot of people were thinking it was going to start going up this year, but the data just doesn't really support that. And that's why we continue to see headline inflation continue to go down. If you look at apparel, you can see it basically it's negligible in terms of its contribution here right now. Transportation is subtracting from overall inflation, right? So it's negative 0.2 of the 2.41. So obviously, if transportation were to go back to being inflationary, then that would send headline inflation back up, right? But right now, it's actually helping bring headline inflation down. In fact, if transportation were just back at zero, it might, it'd probably get your headline inflation back up to 2.5, 2.6%. But because it's deflationary, it's causing another drag on it. If you look at medical care, it makes up a relatively small component, although it still is about 1/10 or so. Recreation is almost negligible, 0.0378 of the 2.41. And then education and communication is fairly negligible. Other goods and services is essentially negligible. So it really does just come down to a few categories that are primarily responsible: food and beverage, housing, was it recreation? No, it was not recreation. Medical care and transportation. I mean, those four categories alone are responsible for a lot of what's actually going on with the CPI metric. And of course, medical care, transportation has helped bringing it down, right? But if you remove transportation, I mean, you can see that those three categories right there basically get you to the headline number. It's transportation that brings it down a little bit, and then the other categories that account for the deflationary component of transportation. So it's interesting because you could essentially look this month at just food and beverage, housing, and medical care, and that's essentially what's giving you your number, right? And the other stuff is basically just a wash, right? The deflationary components just cancel out with the inflationary components in terms of CPI, and it just comes down to food and beverage, housing, and medical care is what's getting you your overall headline number. Now, core inflation is a different story, right? So headline inflation dropping might make you think that, hey, maybe the market's thinking, all right, well, if inflation's continuing to drop, maybe we'll get another 50 basis point rate cut. But then you go over to the market and you're like, well, let's see, does the market agree with that assessment? And think there we go. It's loading back up now. If you wonder, is the market agreeing with that assessment? And you can actually see that following the rate cut, there's now a 20% chance that the Fed keeps rates paused in November. Still more likely than not that they're going to cut, but you can see the market's not even considering a 50 basis point rate cut right now. Now, of course, we're going to get another unemployment rate print between now and the next meeting, so it's possible that a 50 basis point rate cut starts to get, priced in by some investors again. But in the short term, it looks like investors are more concerned with inflation than they are, or growth, I should say, than they are with a recession where rate cuts are needed aggressively. And you can see it pretty clearly. Because again, if a recession were being priced in aggressively, you would expect a lot of rate cuts, not the market thinking, hey, there's a 20% chance the Fed might not cut rates at all. So the answer to that is with core inflation. So headline inflation looks pretty good, right? I mean, it looks like it's heading back to 2%. Core inflation, on the other hand, it's stalled out at around 3%, right? And this is one that topped a lot later. If you guys remember, in 2022, core inflation did not top until September, whereas headline inflation topped in June. So it kind of makes sense that if core inflation is going to take longer to top out, it's probably going to take longer to bottom out as well, to really reach the target that the Fed wants. And so the question is how much longer is it going to take for core inflation to get this drop below 3%? Because I guarantee you the Fed does not want to cut prematurely. If you go back to 1972, you can actually see that core inflation stayed a bit stickier and actually continued to drop even into the end of the year, but then it went up the following year. And core inflation is not yet at the point where it really should be before you would really expect continued aggressive rate cuts, right? If the Fed cuts too aggressively and core inflation just starts to go back up like it did in 1973, the Fed's going to have to answer the question, you guys saw exactly what happened here in 1970, where headline or core inflation topped out at 6.6%, which is basically exactly where it topped out here in 2022. You brought it down, but you didn't do enough, and now we have another wave of inflation. So I think that's the reason why the market is looking at this and thinking, you know what? Maybe we don't need another 50 basis point rate cut. Maybe not only should we consider a 25 basis point rate cut, but there's a chance, there's a 1/5 chance that the Fed doesn't need to do anything at the next meeting. So it's kind of interesting. And one of the things we spoke about a lot was that when the Fed cuts rates, right? We said when the Fed cuts, there is a good chance that yields will rally, right? And the reason I said that was because if there is no immediate sign of a recession, then what are yields doing at 3.5%, right? That's where this is getting, into peak scare. People are worried about a recession. And then because the Fed's cutting rates, the SOM rule's going off, the uninversion of the 2-year and the 10-year yield, but oftentimes it can take months before it actually plays out. And so the question that you have to ask yourself is, when yields were at 3.5, when the 2-year yield was at 3.5%, what business did it have being down there unless a recession was immediate? And then following the 50 basis point rate cut, we got an unemployment rate that dropped to 4.1%, and we got non-farm payrolls that were like 250K. So then you go from one extreme of thinking you're going to have several aggressive rate cuts to the opposite of wondering, oh crap, maybe the Fed made a mistake. And now we have to worry if they actually stayed the course long enough like they said they were going to do. So now that 50 basis point rate cut has happened, do they follow it through with another? Or do they look at this and say, maybe we cut a little bit too much too prematurely? At this point, I think I think the right thing to do for the Fed, let's see where the next unemployment rate print comes in, right? If it keeps going lower, then why do they need to cut, right? I mean, why do they need to cut if it's just going lower? If it does something like what it did in 1957, then they probably would cut another 50 basis points, right? Like, so if it does this, like in 1957, everyone compares to the last two, but if you look at 1957, the unemployment rate went up to 4.3, dropped to 4.1, which is exactly what happened, and then and then a month later, it went up to 4.4. So if the unemployment rate comes in at 4.4% in November, then the Fed would continue their aggressive cutting cycle. But if it keeps dropping, and let's say it goes back to 4% or 3.9, you really have to wonder, what are all the rate cuts needed for? Now, what are the implications for assets, right? Well, I mean, in the short term, Bitcoin has obviously taken a hit. And if you guys remember, I said that one of the most likely outcomes here in the short term was that it could follow what it did last cycle after the first rate cut. And as much as so many of us would like to pretend like monetary policy does not play an important role, it continues to play an important role, right? Because last cycle, after the first rate cut right here, Bitcoin rallied 2 weeks and then it dropped right back down. And here we go, right? Bitcoin rallied 2 weeks. The first rate cut was this week right here, rallied 2 weeks, and now it's dropping right back down. So it seems like it's playing out in a similar fashion. Now, that's not to say that it has to continue playing out like that. If you guys look back last year, you can see that Bitcoin sort of rallied into late September, early October, had a 2-week pullback, and then late October, it was off to the races again. So I don't want you to assume that that can't happen, or at least a return to this trend line. It's possible that Bitcoin does return to this trend line, and it could still happen later on this month or next month, potentially. But the point is, I think crypto is more so tied to rate cuts and liquidity than the stock market is. And the minute you take away some of those aggressive rate cuts, all of a sudden, we're over here in the Cryptoverse ahead of ourselves once again. Because last cycle, and we've talked about this, and I don't really have the answer, right? You could argue you could argue that Bitcoin is here, where it's about to get a pump, and take out that lower high. Or you could argue we're right here following the first rate cut from last cycle. Because again, the first rate cut last cycle occurred right there. And if that's the case, it could just mean a little bit more chop through the end of the year. And there could be another drop to the 100-week moving average. Again, the 100-week moving average is not something that has to happen, but it could happen, right? And the good thing, the silver lining, is the 100-week SMA continues to go up. So the longer that Bitcoin doesn't go there, the better, because the spot at which it resides continues to go up. But it's interesting how this is all playing out. Now, how about what else did we say? We said that if the long end goes up, then the dollar should follow, right? Look at the 10-year yield. It's up to 4.1%. We did a video on it over here. We talked about it a lot, saying it's likely going to rally following the first rate cut. It has. It could go even higher to 4.2, 4.3%. It's already passing its own bull market support band. And what I said was that if the long end rallies, then it should take the dollar with it. And sure enough, it's taken the dollar with it, right? If you look at the dollar, you can see it's following the 10-year yield perfectly. So go take a look at the dollar in isolation. You can see that it's back up to around 103, 102.992, right? It's back up to its own bull market support band. Now, the reason why that's important is because when the dollar rallies, net liquidity drops. Now, there's two ways you can measure that liquidity. You can look at it through the central banks, the balance sheet of the central banks. You could also look at it through, sort of the global money supply. But whichever way you measure it, the dollar going down means net liquidity goes down, because you're converting the balance of all these other places, all these other currencies back into US dollars, and if US dollars are strong relative to those currencies, the net liquidity goes down. So risk assets on their USD pairs tend to track the money supply, right? They tend to track the money supply, but to track net liquidity as a function of pairs. So I think you can argue that as net liquidity goes down, all Bitcoin pairs go down. And you can see that all Bitcoin pairs are getting hit once again. So if Bitcoin rallies, right, then it might take all Bitcoin pairs off support, because they're more reliant on rate cuts than Bitcoin is. They're actually more reliant on that, I think, than Bitcoin is. But if, on the other hand, Bitcoin dumps, they could dump quicker than Bitcoin, thus making my argument about Bitcoin dominance still my strongest conviction. Now, it is true that I do believe Bitcoin dominance will go down next year, and it is true that this week Bitcoin dominance is down. But I still would encourage you to look at the larger picture for Bitcoin dominance and to see, it's still trending well above its bull market support band. Yes, at some point it's going to top out, right? But I still think the top is ahead of us and not behind us. If dominance can't take out, this prior high before the end of the year, then there's a good chance the top is in. But I still am in the camp that Bitcoin dominance will ultimately go higher from here. So that is my base case. That doesn't mean it has to this week, but I just think that at some point, all Bitcoin pairs are going to look at net liquidity and be like, oh, okay, I guess we're going down. They're going to go down against Bitcoin, and then QE will begin, and that's where all Bitcoin pairs bottom, and that's where Bitcoin dominance tops. So those are my views. Those are my views on inflation, how it affects the markets. And yeah, I mean, the thing about Bitcoin is that it still is following two paths really, really closely. And one of those paths is sort of right here where it broke out. And the other path is right here where it just came back down following the first rate cut. And it's also potentially lining up with what happened right here, right? A 2-week pullback right there before later October going up. I don't think anyone knows what's going to happen, right? I don't think anyone knows. And anyone telling you they know, you look at the track record, they're probably wrong, just like I've been wrong about a lot of things. So I think it's better to be a student of the market, have a plan no matter what. Don't pretend like we know what's going to happen, because we don't. But I think the best thing to do is just to consider all scenarios, figure out how you want a portfolio allocation based on those scenarios, weight it more so to the scenario you believe in the most, but don't weight everything based on that scenario, because you got to admit, hey, what if you're wrong? You know? You know, and this is what I've been saying all year. And for really the last 3 years, right? Bitcoin heavy has been a great way to go for the last 3 years. Not just because Bitcoin went up on its USD pair, but because most everything else in the cryptoverse bled against Bitcoin, right? That's the reason. It was to preserve the Satoshi value of your portfolio. And I can say that on days where dominance is down because the overall trend is clear. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.